Attention all risk takers, Christmas has come early. You came here for the truth, so let me unveil that for you. The Federal Reserve has not only kept interest rates where they are, they have signaled that this is likely the last rate cut that was back several months ago, and that next year, 2024, there will be at least 3 rate cuts to be expected. The market took that and it ran with it. Let me tell you, it ran real fast. There was a press conference. I watched it so that you don't have to. And basically, there was a question that was right at the very end of it all. During that question, he explained something that I think everybody needs to know. And yet, it's so complicated and complex, convoluted, that most people will glaze over it. So in this video, I'm breaking it all down. I'm going to show you some very key information that, like I said, most people just won't get into. But on this channel, I bring you what I believe to be the most important, because this will tell us that it is looking very likely that quantitative tightening will end next year. The rate cuts will begin and inflation is going to go wild. Let's get into all of that here. Fed prepares to shift to rate cuts in 2024 as inflation eases. I know you've been seeing all the videos everywhere. You have to watch yesterday's video where I broke down absolutely everything, but you can obviously tell what their intentions are. They want to create more inflation. They're not going to use real measures of inflation. They want to use their inflation. So what you think is going to happen to asset prices, especially those risky assets? Well, we're going to break this down right here and now. The last question before he scurried off stage was something so important. And I transcribed it. I took that information and I started to break it all down. And I want to do that right here. What we're seeing on the screen is something very important, but you're going to see this like, hey, that's real messy. Okay. Everybody on my Finance Friday live sessions, which I'll talk about at the end of the video, they know exactly what this is. Okay. This is the money mirror method, or part of it anyway. And what we're looking at is a few things. The white line there, that's the S&P 500. That's the stock market. The orange is the reserves. Okay. What are reserves? Think about it. You put your money into the bank. That bank has, they can lend out with fractional reserve banking. They can lend out a lot of money and they don't need to keep it all there. You know how it works. Those reserves, excess reserves, can be stored at the Federal Reserve. And so we see how that fluctuates over time. And then we have the reverse repos. Reverse repos, which I'll get into, are something that can add liquidity into the system. All right, that's the pink line. And so that was at $2.3 trillion a day that was trying to add liquidity into the system during this period of difficult time. And now that has really changed. That has started to come down. And Powell was asked about this, mentioned this. And so I think it is extremely important to break that down right here and now. The question is, she goes on and says a few things, but has there been any consideration of altering the pace of quantitative tightening at all? Powell comes in and had a few things to say. Stick with me, by the way. I'm going to break it all down and I'll look at each aspect. This is going to affect stocks. This is going to affect real estate. This is going to affect cryptocurrencies, Bitcoin, everything. We are not talking about QT right now. So the balance sheet seems to be working. That's the runoff, the quantitative tightening. Seems to be working pretty much as expected. What we've been seeing is, that we're allowing the runoff each month, and that is adding up to, we're at about close to $1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly. As you can see with that pink line, is coming down real fast. And it's been coming down quickly, and the reserves have been either moving up or, as a result, holding steady at a certain point. That they won't be any more to come out of. Now, by the way, that's transcription, so take it with a grain of salt here. That orange line, what he's saying here is that, it's at or about this level, or it has come up, referring to those reserves. Okay. And I explain what those reserves were. So here we go. Then he said this, there'll be a level that where reverse repos, there's going to be a level where the reverse repos level out and the reserves will start to come down. We intend to reduce our securities holdings, that's mortgage-backed securities and treasuries. So they want to get rid of some of those. This is hilarious. Until we judge that the quantity of reserve balances has reached a level that is somewhat above that consistent with ample reserves. Confusing, I know. Hold on there. And what is he saying? Okay. That they're going to continue quantitative tightening until those reserve balances get to a point at which they say is healthy enough, but not too low. Why? Well, they did that in a prior cycle when Janet Yellen, my favorite, Janet Yellen was at the chair position and the market started freaking out. Oh, we went too far. We need more reserves. So that's what they want to avoid this time around. Okay. And suggesting here, we intend to reduce the securities holdings. We will also intend to slow and then stop the decline in the size of the balance sheet reserve are at somewhat above the level judged to be consistent with ample reserves. We're not at those levels yet. Confusing a little bit, I know, and it's transcription. You know how he talks all over the place, he stutters and things. But the point here is that they want to go ahead, reduce the amount of treasuries, mortgage-backed securities, but it's going to stop at a certain point in the near future when they think reserves are at that sweet spot. So when will that happen? Well, it could be at any moment. But he makes it clear that no, it's not today, it's not tomorrow, but it's going to happen. If we're expecting rate cuts, if we're going to look at that during this time, I think it is pretty obvious that at some point, reverse repos going from, a very high level coming rapidly down, we are only a few months away from that time. So here we are, December, end of the year, come March, it wouldn't surprise me that if they're not already during that period of time talking about it, that they're going to start mentioning, okay, maybe the next one, maybe they're going to start that policy of basically getting rid of the quantitative tightening if it doesn't happen all at the same time. Okay. What you need to know from all of this, what is the effect? What is the impact? This is going to be bullish for risk assets. It already is. I mean, come on. If you were watching the markets, I was watching that on these 4 time frames, if you could see behind me, seeing every comment he made and then how the market reacted to it, it was going off the charts. It just kept going up and up and up and up because they loved it. It was seen as finally dovish as they did expect. Okay. And then at the same time, we've got this. Stock buybacks, how these companies love to buy back their own shares like Berkshire Hathaway and so on to push up the price of their shares. Well, in this case here, we're talking about buybacks, but a little different. Treasury buybacks. Well, their plan will boost market resilience. The department has said buyback programs will begin in 2024. Buybacks will seek to aid liquidity and improve cash management. So very simply right here, what they want to do, the Treasury, the one who's packaging up all the debt, well, they want to buy back that debt. Okay, how do they actually buy it back though? Like, where do they get the money from? Okay, well, they can raise more, they can create more debt and have investors buy it. They can raise taxes. They can do any number of things. But it's weird because it's like some circular voodoo thing that they've got going on, just like with the reverse repo operations, with the Federal Reserve just kind of creating this nonsense thing that they do. The point here is that this is going to be a stimulus in effect. It's going to create a stimulative action, which is what they want. And that means, again, more bullishness for these markets, not in a good way. What the market needs is an economic detox. The economy needs an economic detox. Companies that suck should fail. They shouldn't be bailed out. They should fail. And I know that sucks for the people working there, but let's be honest. I remember seeing it with my own eyes. Companies, let me just say, where there were people sleeping under their desk like it was a Seinfeld episode. Sleeping under their desk. People who would sit around all day doing nothing. Well, another company came in, this financial company came in, they bought them up and they slashed departments heavily. Now, let's be honest. That's not very nice. But what happened here? They had to increase productivity. The company was bleeding out, and that's why it needed to be purchased in the first place. And so that's what's going to happen. That's what goes on all over the place. And these times are very challenging. There will be job losses, certainly. It's not necessarily going to show up in any statistic, but know what they're doing right here on all the different levels is very stimulative. It is a form of, it might not be necessarily quantitative easing, but everything that they're doing is going to create more inflationary, basically putting out inflation. And that's not good. Asset prices can rise. There's no question about that. And we generally see it at the beginning in the worst of the worst stuff, all that stuff that nobody wants, once they feel comfortable. Because it's like, oh, we're risk on, let's make it happen. And that is a big concern, of course, for you and I. We know that. We know this to be the case. If you want to understand the money mirror method, if you want to know how I pinpointed the exact bottom of the stock market last year, I told you about that September, then I told you again about a week or two later, pinpointed it exactly. But why? Because it's the money mirror method. And when you follow along with that and you understand what I talk about here, you can be ahead of the curve. I mean, it's a simple matter of fact. That is only for those who are part of my group. I was calling it previously the mentorship group, but basically it's the Finance Friday. And what we talk about there is what's going on with the money mirror method. I show you the charts. I look at it. I've been being able to pinpoint this. It is frightening because what I see is a greater and greater divide in between the rich and the poor and the haves and the have-nots. When I say this stuff, I'm not saying it as if it's positive. Oh, it's great. It's fantastic. Hey, the market's going to go up and everything. How are people going to afford anything? That's the concern I have. So when I talk about collapse and so on, I'm talking about the economy. The markets, they can go up. The housing can go up. And that benefits a small, select few people, while everybody else, they're getting squashed. And you could say, oh, they should just buy those stocks. And certainly they can. But, well, I think they're probably going to be more concerned about how they're going to be paying this ever-increasing debt. That's the biggest issue. They're using buy now, pay later for a reason. That's what's going on here today. I hope that you'll join me on that. Link will be in the description below. And of course, the comment of the day. I love these. Eric says 2024 will be unlike anything that we've seen. Inflation may be going down according to the government data, but ask your average American and they will tell you how things are getting more and more expensive, especially food, housing, and so on. Totally agree. And absolutely we will see the biggest concern, unless this whole thing could be derailed by some sort of catastrophic event. Is it here yet? I don't see that at all. Where is it? Swept under the rug. And we're going to see what happens. Like the Loch Ness monster hiding, just waiting to come out. Until then, more inflation. Let me know what you think. Do you agree? Disagree? Let me know in the comments. Hit that thumbs up on the way out. Not just because it supports me, but it notifies the algorithm that this is good stuff. And generally people do not talk about this. It's complicated. I know it could be complex, but we got to know the truth. All right? I want to see you back here tomorrow. So come on in, the Money GPS, each and every day, bringing you the latest and greatest information. See you then. Take care.